Hey everyone, welcome back to Corporate Decoder, the place where we take those giant corporate reports, the ones that could double as doorstops, and turn them into something you can actually understand. Today, we're diving into the world of Marcus and Millichap, a big name in commercial real estate. And let me tell you, this report is a bit of a roller coaster, so buckle up. It's all sunshine and rainbows one minute, then market volatility the next. You'll see what I mean. Marcus and Millichap isn't selling houses, they deal with commercial properties like apartment buildings and shopping centers. Think of them as the matchmakers between people who want to buy these properties and those who want to sell. But the last couple of years have been tough in the real estate world, so let's see how they're navigating the storm. First things first, a quick overview. While 2024 wasn't a total disaster, it's clear the company is still feeling the squeeze from the economic climate. They managed to close over 7,800 deals, totaling almost $50 billion. But the overall vibe is one of cautious optimism. One thing that always perks my interest is where the money comes from. In Marcus and Millichap's case, most of their revenue, about 85%, comes from those real estate sales commissions. The rest is from helping people finance deals and some advisory services, which is like giving real estate investment advice. To really understand their business, they break down the commercial real estate market into price brackets. Properties priced less than $1 million, the private client market, which is their bread and butter, and then the middle and larger transaction markets. About 62% of their commissions came from that private client market, the $1 to $10 million range. They're the kings of that segment, and that's what separates them from the competition. This isn't a market filled with huge corporations, it's everyday investors, and they don't always react to the economy the same way the big guys do. Now, I'm going to scroll down here to a big section. These reports are required to have it, and it's the risk factors. It's where the company lists everything that could possibly go wrong. In this area, we see the main headache for Marcus and Millichap continues to be the overall economy and commercial real estate market conditions. There is so much uncertainty, from fluctuating interest rates to potential recessions. All these things can scare investors and reduce the number of deals. Basically, when the economy coughs, commercial real estate gets a cold. Another factor is hybrid work. If companies decide they don't need as much office space because everyone's working from home, it hits the demand and values. Like most businesses, Marcus and Millichap has to compete to attract and retain top talent, and they can't afford to lose their key people. They have to make sure these stars are happy, or they might jump ship to a competitor. Finally, there are always legal and regulatory risks, keeping up with licenses, rules, and regulations across different states and even in Canada. It's a compliance minefield that can lead to fines or worse. I am going to scroll again, and now I'm landing in the land of numbers, the financial statements. The key here is that total revenue actually increased this year to almost $700 million. That's good news. But operating expenses also went up, so the company is still trying to get its costs under control. But this is a good direction, as it shows a recovery from the 2023 to 2022 period of declines. Looking at the sources of the total revenue increase, we see that this jump was primarily the result of increases in real estate brokerage commissions and financing fees, as described below. Also, as you may imagine, the bulk of operating costs were paid out to the investment sales and financing professionals. Let's look at this stock chart here for a second. This chart is intended to show how well they are performing as opposed to the overall market or competitors in similar lines of work. As you can see here, overall they are performing worse than both the S&P 500 index, tracking the 500 largest public companies, as well as its peers such as CBRE, Colliers, Cushman, JLL, and Newmark. This could indicate that the firm is suffering more than its competition, or just could mean they have some room to grow going forward as things improve. Scrolling down, next up, we have a section on liquidity and capital resources. Their cash flow, they ended the year with about $153 million in cash. They attribute it to some timing of payments, so they don't seem too concerned. And they do have a credit line they can tap if needed, though they're not using it right now. I want to talk about off-balance sheet arrangements. It's the strategic alliance with M&T Realty Capital Corporation. Now, this is where it gets a little complex. Basically, Marcus and Millichap provides loan opportunities to M&T and then guarantees a portion of those loans that M&T makes. So there is a guarantee obligation on the books of almost $300 million, but an allowance of only $174,000 to account for potential defaults. This definitely warrants closer observation. Here is where the report gets interesting, specifically the insider adoption or termination of trading arrangements section. It shows when company insiders, like executives or board members, set up plans to buy or sell company stock. And it looks like the president and CEO, Hessam Naji, adopted a Rule 10b 5-to-1 trading arrangement in November, which would allow the sale of up to 20,000 shares. Anytime you see this, it's worth keeping an eye on to make sure that the C-level officers aren't jumping ship. The plan only started recently, and there doesn't seem to be reason to be alarmed. The plan also has many limitations and is only going to be active for about a year. Alright, I want to give you my overall assessment of Marcus and Millichap. In essence, it's a company at a crossroads. On the one hand, they are still the big fish in the private client pond, and their increasing revenue and brokerage commission shows a step in the right direction. On the other hand, they have increased operating costs, which are going to make any gains into the immediate future difficult to manage. The partnership with M&T Realty Capital is one of the risks. If those loans go bad, Marcus and Millichap could be on the hook. So there's potential for the company to increase revenue with this plan, but also a high risk factor as well. Overall, I'd say Marcus and Millichap is a company to watch. If they can keep costs down and capitalize on their leadership position, then they could be a very solid investment in the future. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, be sure to hit that like button, drop a comment with your thoughts, and subscribe for more deep dives into the world of corporate finance. Until next time, keep decoding.